This is the 10 easy steps we are going to take to create wealth. So the first step that we need to take if we are going to use debt to create wealth, we must plan for contingencies, the unforeseen events, things that disrupt our budgets, things that cause us to go to unplanned expensive borrowing, things that cause us to dispose our assets in a hurry. And when we dispose our assets in a hurry, then sometimes we even lose our investments. And so there are two ways of dealing with contingencies. For the big ones, these are the things that will obviously require a lot of money. We do something called risk transfer, and risk transfer is insurance. Here I'm looking at something like medical. We cannot be able to deal with our medical as and when they come, and that's why we join a medical scheme. That's why we join NHIF, so we can actually be able to take that liability and place it in the shoulder of somebody else, so that if it arises, then we don't have to borrow to be able to deal with that. We can buy insurance for the house, we can buy insurance for the business. Ideally, these are contingencies, they are unforeseen, but if they happen, they have this bad habit of destroying our wealth. So we are trying to ring fence our wealth so that even if we had gotten it from debt, we will not be put down where we have to pay the debt, yet we do not even have what we had done. The second level, while we are planning for contingencies, which we can also consider to be our second step, is building a small buffer for emergencies, a safety net, for handling the smaller things that happen to us. Small demands for money, if something happens and you urgently want to fix it. I mean, if somebody is a driver and their car breaks down in the middle of the road, you actually require the towing services, you require to repair your car on a very, very short notice. Those are contingencies that we will not be able to transfer to somebody else. We also have to consider the possibility sometimes of getting separated from our income, which happens a lot of times. People lose their jobs, people get retrenched, businesses burn, and when all those things happen, expenses still come. So we need sort of a cover. We need some sort of protection to cover us for some time before we find our food. Professionally, we say we need to have a fund that can actually pay all our bills for a 3-month period if we were separated from our income, so that life can continue. So in planning contingencies, we have two important things. One is risk transfer. This is what is insurance. And the other one is building the contingency fund. If we take those two steps, I think we'll be part of the way of now being able to use debt so that we can be able to create wealth. Step number 3 is what we call building social capital. When these small things come, if I don't have a way of looking for the money, I'll be forced to go for expensive credit. This is where people have apps on their phone. This is where people talk to the Shylock. But what if you had trusted friends who you can borrow from? You can borrow from each other on a short notice. Effectively, when you borrow from your friends, they don't charge you interest. And that means you avoid paying high interest, and sometimes you also don't miss opportunities. There are sometimes when you see very good opportunities, and you realize, if I have to go and look for money to do this, maybe to put in a deposit, say for a property, by the time you get the money from the bank, this property might have gone. But if you have a group of friends who can actually lend you money, you put in whatever down payment is required, and when you borrow from the bank, you pay off their money. See, you will have taken advantage of that opportunity. It means they should be able to help me when I am in need, but in turn, I should also be able to help when they need. But this happens if we are honest with each other, that when I borrow from Chris, I will pay without Chris having to apply pressure on me. So it is important to build social capital. The fourth step is about building a good credit score. Now, when your credit score is bad, it means you killed your possibilities of borrowing. Now, if you killed your possibility of borrowing, then it means you cannot use debt to create wealth. But if you have a good credit score, then obviously means as years goes by, you become somebody who is easy to borrow. People can lend you money easily. This is how credit history is kept. You can only borrow if you have somewhere to borrow from. And this means if you're not in a circle, then you have to join a circle. So you must join a cooperative. And not only joining to put in minimum contribution. If you're in business, I know you want to borrow from the bank. So it is important to build a good cash flow with the bank. Bank does not lend you based on the balance you have there. No, they will lend you based on money movement. If you're going to borrow from the bank, then you must ensure money goes in and money comes out. That's what they're going to look at. We're saying if you want to create wealth using debt, then let's build the vehicles. It's to set ourselves what we call a budget rule. A budget rule is like, how much of my revenue should I use to service debts? Because if you're using all your money to service debts, then the challenge is we will not be able to meet current commitments. And if you don't meet current commitments, what we do, we would have to go and borrow to be able to meet that. Set a rule so that we're not spending more than 35%. The only time we spend more than 35%, and it's not an issue, is say we are servicing a mortgage, because a mortgage has two components. One of it is the principal, the other one is the interest. The principal component is an investment, really is not a loan repayment, because that becomes what creates value in your house. First, evaluate how much of my income am I using to service the loan, and so set a rule, and 35% is a good indicator. Step number 7, and this is very key, we must always distinguish between bad debts and good debts. Bad debts is any money which we borrow, and where we put it, it has no potential for a return. It will not give us a return, and it will not give us any future value. On the other side, there is good debt, what we call investment debt. Money that we borrow, and where we put it, it's going into an appreciating asset, or it is creating value for future income. Step number 7 is something called understanding the cost of money. Because when people are lending you, they'll give you different terms. There are people who give you the rates per annum. There are people who give you the rates per month. There are people who give you on a reducing balance. There are people who give you on the original amount. But because sometimes we don't actually work it out, and I've seen on those mobile apps, people are paying interests. So one where it is 600% per annum. If somebody said I'll charge you 600% per annum, would you really even want to think about it? Central bank has set up a calculator to be able to work out these things. It is called cost of credit. If you go to their website, the website is costofcredit.co.ke. It actually carries in bank charges, third-party fees, it carries the interest component, and it helps you to see how much you're paying. You will be surprised when you work out those figures. Step number 8 is you need to have a plan before you take a loan. If you're going to take a loan because somebody makes the loan available for you, then there's always going to be a problem. If you want to create wealth using debt, you must think through the plan before you borrow. Because sometimes we get tempted, top-ups, you take a loan and then they call you, they give you more money, you have no plan, you consume that. Or is it to get loans, the ones on the phone, the ones people tell you don't have to be an account holder, those ones work against us. If you have a plan before you have the loan, first you know how much you need and you will have thought through the process. Step number 9 is understanding what lenders are looking for. And lenders generally look for 5 things, and it's very simple. First, they want to know your credit history. So create a good credit history, your character of borrowing and paying. The second thing, they want to know your capacity to repay. So always make sure that you organize your capacity. Think through, how am I going to pay this? Don't ask for what you can't pay. Number 3, they will ask for security, collateral security. If you are in the cooperative, collateral security is your guarantors. If you're going to the other institutions, they have different types of security. Number 4 is your capacity to apply the money in the business, especially when you're going to the banks. They want to know, what are you going to do with this money? Lenders would always want to know, if things don't work, if things go wrong, what are we going to do? And this is where we got things like auctions, we have things like foreclosures. Once you understand that, it makes it easier. And the last one is investing in the self. For all those things, we need to build our financial knowledge, because when you build your financial knowledge, you become better. And there are very many places where you can do that. You can go for seminars. Even banks call people for seminars. Sometimes they have account holders club. You can go for courses. You can go for exhibitions. When you see an exhibition, you can show up. You can take a course. And that's why we are asking you to think about the Wealth Creation Masterclass, which is structured, which is a place that can help you to avoid the mistakes that others have made. We are the Personal Finance Academy Kenya. We have our website if you want to get to know more about us, pfa.co.ke.